I've been staring at a number all morning that honestly makes my head spin a little bit. 65,000.
That's a big number. What are we counting today?
That is the approximate number of pharmaceutical distributors in India right now.
Wow.
65,000 separate entities serving about 800,000 retail chemists.
Hmm.
I try to visualize it, and it looks like a spiderweb of absolute chaos.
It really is. And to give you some context on just how fragmented that is, if you look at the United States, the top 3 distributors control over 90% of the entire market.
90%.
In India, the top 3 players, they struggle to even hold 10%.
That contrast is just staggering, and that chaos, that fragmentation, is exactly where our topic for today lives. We are doing a deep dive into Entero Healthcare Solutions Limited.
This is a fascinating one. Entero isn't just a delivery service or, a simple logistics company. They're pitching themselves as a kind of digital highway.
A digital highway.
Yeah, one that's trying to organize this massive fragmented mess.
A digital highway for drugs. I like the sound of that. But here's the real premise for today's deep dive and why we're looking at this as a serious investment case. The big question is this: is Entero destined to become the McKesson of India?
Referencing that U.S. giant you just mentioned.
Exactly. Or are we looking at a really risky roll-up strategy that's, I don't know, walking a tightrope of razor-thin margins?
That is the billion-dollar question, literally. And to answer it, we really need to unpack their business model, this massive macro runway they have, their very aggressive acquisition strategy, and, of course,
The risks.
the specific risks that could derail the whole train.
So let's start with the mess itself. You called it the fragmentation paradox in your notes. What exactly is going on in the Indian supply chain? Why is it so broken compared to, say, Germany or the U.S.?
Archaic. That's
Yeah.
probably the best word for it. It's a legacy system that is just incredibly multi-layered.
How so?
Well, you have the manufacturer at the top, then you have these carrying and forwarding agents, or CFAs, then super stockists, and then finally these thousands upon thousands of small local distributors.
Okay, hold on. Let's just clarify CFA. We're not talking about a chartered financial analyst here, are we?
No, not at all. In this world, a carrying and forwarding agent is basically just a logistics partner. They hold stock for the manufacturer in a specific state, mostly for taxes and transport, but they don't really sell. They just forward it down the chain.
Got it. So if I'm a regular chemist, the person running the pharmacy down the street, what does my day look like dealing with this?
It's a headache, a huge headache. A retail chemist often has to deal with 50 to 100 different stockists
100.
just to keep their shelves full. Can you imagine managing 100 different vendors just to run one small shop?
That sounds like a nightmare. You'd spend half your day just on the phone?
You would. And despite all that effort, they still face stockouts. If a patient needs a specific heart medication, the chemist might not have it because the one specific stockist for that brand didn't deliver.
Ah.
The whole system runs on informal credit and massive inventory redundancy. Everyone is holding too much stock because they just don't trust the supply chain.
So the opportunity here is just moving from this chaotic, unorganized mess to something well-organized.
That's the entire thesis. We're looking at a huge shift from unorganized to organized distribution. The addressable market here, pharma plus medical devices, is valued at roughly $33.2 billion.
So about 2.7 trillion rupees.
Exactly. And it's growing at a CAGR of 10 to 11%.
That is a massive pie.
It is. And the whole investment thesis relies on one idea: structural consolidation. Just as the U.S. and Germany consolidated to where the top players hold 95% of the market, the belief is India has no choice but to follow.
Efficiency wins in the end.
It usually does. Entero is betting everything that they will be one of the survivors who consolidates that market.
Okay, so that's the why. Let's get into the how.
Yeah.
Because saying you're going to fix a billion-dollar mess is easy, but, doing it is the hard part. I keep seeing this word phygital in the reports. It sounds a bit like a marketing buzzword. What does that actually mean for them?
It is a bit of a buzzword, I'll give you that, but in this case, it's actually pretty accurate. It's a hybrid of physical infrastructure and digital intelligence.
Okay.
Physically, they are a B2B distributor. They buy from over 2,700 manufacturers, and they sell to over 95,000 retail customers. Pharmacies, hospitals, clinics, they've got the warehouses, the vans, the whole 9 yards.
But the digital part is where the secret sauce is supposed to be.
Right. They have this B2B app called Entero Direct. Think of it as an app for chemists. So instead of calling 50 different guys to order stock,
You just use one app. A single-click system.
Exactly. It offers real-time visibility on inventory, on pricing.
That seems pretty obvious, though. Why hasn't everyone else done that?
Well, because the local distributors, those 65,000 small players, they often benefit from the opacity, from the lack of transparency. They don't necessarily want you to know the real price or their real stock level.
Okay.
Entero is bringing that transparency, and that creates stickiness. Once a chemist gets used to ordering everything on an app, are they really going to go back to calling 50 random guys?
No way. It's the Amazon effect. Convenience always wins.
And that tech stickiness is their attempt at building a moat. It allows for what they call demand aggregation.
Dinging.
By consolidating all these purchases from thousands of chemists, Entero can go to the manufacturers and demand better pricing because they're buying in huge bulk, and then downstream, they can offer better fill rates to the retailers.
Now, I want to touch on the financials of this model, specifically this J-curve that's mentioned. Whenever I see a J-curve, it usually means we're losing money now, but trust us, we'll make money later. Is that what's happening?
Well, they're just getting past the bottom of the J. They're transitioning from that cash burn phase of building all this infrastructure to a phase of operating leverage.
Okay.
The sources highlight that in the second half of the year leading up to May 2025, they actually turned operating cash flow positive.
That is a huge milestone. It means the machine is starting to power itself. But, and here's where I want to push back a little, they aren't just growing by signing up new chemists one by one. They're buying their way to the top.
The acquisition flywheel, you're right. This is the absolute core of their growth strategy. Entero is essentially a roll-up corporation.
And what they do is they identify regional leaders, these distributors, with deep local relationships in a city or a state, and they just acquire them.
That's the playbook.
Roll-up is a term that makes some investors really, really nervous. It can feel like financial engineering. You're just stapling businesses together. How does the math on that actually work?
It relies on arbitrage. So they typically buy these private local companies at single-digit EBITDA multiples, say 5 to 8 times earnings.
Okay, pretty cheap.
But Entero, as a public company with this tech platform story, it trades at a much, much higher multiple on the stock market.
So they buy $1 of earnings for $5, and the market instantly re-rates that same dollar at what, 20 or 30 bucks because it's now part of Entero?
That's the mechanism. It creates instant value, at least on paper. And the pace has been aggressive. They've done over 35 acquisitions since they were founded. In just the first half of fiscal year 26, they closed 5 of them.
But is it just buying revenue? Because that's the classic roll-up trap. They crash when they run out of things to buy or they can't manage what they bought. Is there any actual organic growth under all this shopping?
That's the crucial check. And the data suggests they are actually operating well. Organic growth, so growth from the assets they already own, was roughly 13.4% in Q2 of FY26.
And how does that compare to the rest of the market?
Well, the Indian pharma market, the IPM, it grew at about 7.3% during that same period.
So they're outperforming by almost double on their own steam. Okay, that gives me a bit more comfort. It's not just a shopping spree. They are actually selling more stuff.
Yeah.
But let's talk about the money again, because distribution is just notoriously low margin. You're moving boxes. How do they ever plan to make real profit?
You've hit on the margin expansion pivot. They know standard pharma distribution has razor-thin margins, so they're shifting the product mix.
Towards what?
Towards higher margin products, specifically med tech and surgicals.
Medical devices, why is that better?
Think about it. Consumables for cardiology, orthopedics, things like stents, sutures, the margins there are double-digit compared to the low single digits you get in standard pills.
And they've even launched their own private label brand, right?
Yeah.
Entero Surgicals?
Yes. Private label is always the holy grail for distributors. If you can sell your own brand, you keep all the margin.
That makes sense.
And the sources point to this pivot as a key reason why the discounted cash flow models, the DCFs, are showing it as a good bet. If they can pull off this mix shift, the entire profitability profile of the company changes.
All right, I'm getting swept up in the bull case here. Consolidate a messy market, use tech, buy cheap companies, sell high-margin surgical tools. It sounds great, but let's play devil's advocate. What are the risks? Because looking at these reports, there are some flashing red lights.
There absolutely are. And the biggest one, the elephant in the room, is the margins we just talked about. Even with all the improvements, their EBITDA margins are expanding from, 2.9% to roughly 3.4% to 4.0%?
4% EBITDA.
Yeah.
That is razor thin.
It leaves very, very little room for error. If your operational costs spike or there's a supply chain hiccup, you're suddenly in the red. But there's a bigger, scarier risk, a black swan risk,
Which is?
regulatory risk, specifically something called trade margin rationalization, or TMR.
TMR. Okay, unpack that for us. What does that actually mean for the business?
So the government, through the National Pharmaceutical Pricing Authority, or NPPA, wants to keep drug prices low for consumers.
Of course.
One way to do that is to cap the margins that trade intermediaries like distributors are allowed to earn.
So the government could just step in and say, you aren't allowed to make more than, say, 5% profit on this drug.
Correct. And if distributor margins are legally capped at 5% or maybe 10%, Entero's current gross margin model could just collapse. This isn't theoretical, by the way. It has already happened with oxygen concentrators and certain cancer drugs.
Wow.
If they expand that to the broader market, it basically breaks the entire investment thesis.
That is terrifying for an investor. You have zero control over that. It's a stroke of the pen risk.
It is. And then there is the goodwill bomb.
I saw this on the balance sheet. A huge chunk of their assets is listed as goodwill, something like 4 billion rupees.
4,240 million as of March 2025. Remember those 35-plus acquisitions? Goodwill is the premium they paid for those companies above their book value. They paid that premium for the relationships, the local customer lists.
But those relationships are often tied to the person they bought the business from, right? Like Mr. Sharma, who's run the local distributorship for 30 years.
Bingo. And that's the integration risk. In India, business is deeply personal. A chemist buys from a distributor because he knows the owner. Maybe their families go way back.
Right.
Entero buys the company. If that original promoter leaves, or if the culture changes and becomes too corporate, those local relationships could just vanish.
And if the relationships vanish, the revenue drops.
And if the revenue drops, Entero has to impair that goodwill. They have to write down its value on the balance sheet. It doesn't hurt cash flow immediately, but it completely destroys book value and shareholder confidence.
It's the classic death spiral for roll-ups. They buy something, the culture clashes, and the value evaporates.
And that's before you even get to the operational headache. Integrating 50-plus legacy accounting systems onto their main ERP. I mean, just imagine trying to merge 50 different family businesses' ledgers.
It sounds like hell on earth.
It is operationally perilous. They're moving everyone to their Health Edge ERP. One slip up there and you lose visibility on inventory. And in this game, inventory visibility is absolutely everything.
So what we have is a high-growth, high-potential machine, but it's driving on a road just full of potholes. Let's look at the valuation and the verdict. The sources mention a 15-year forecast.
Yes. The deep dive analysis in our source material projects all the way out to 2040, it suggests revenue could grow nearly 9 times, potentially reaching 44,340 crores.
9 times growth. That's the power of compounding at 15% or so a year.
And if they achieve that scale, and this is a big if they get mature market multiples of, say, 15x EV/EBITDA, the enterprise value could hit 48,000 crores.
And considering the market cap mentioned in the source was around 5,000 crores, we are talking about a potential 10-bagger, a 10x return.
Over 15 years, yes. The current metrics certainly support the momentum. FY25 revenue was 5,096 crores. That's up 30% year over year. They're outperforming the industry by 1.5 to 2.0 times.
So what's the final recommendation? Is it a buy?
The sources suggest a long-term buy. And this is a huge, bold, underlined but with a serious warning. The allocation should be limited. They suggest less than 10% of a portfolio.
Because of that concentration of risks, the TMR, the integration challenges, the razor-thin margins.
That's right. It's a high-conviction bet on the consolidation of India. But you just don't bet the farm on a company with 3% margins facing major regulatory headwinds.
That makes total sense. It's a picks and shovels play on the Indian pharma boom. If you believe Indian healthcare is going to grow, you need a circulatory system to move the drugs. Entero is building that system.
Circulatory system is the perfect metaphor. It's vital, it's complex, and if it gets clogged, the whole body fails.
So here's where we'll leave you today. Think about the concept of the moat. We talk about moats in investing all the time, that competitive advantage that protects a business.
Right.
Is Entero's moat currently a fortress, or is it still just a construction site? They're priced for perfection and execution. Can they really integrate dozens of small family businesses without losing that personal touch that makes the Indian market work?
That is the question to mull over. They have the tech, they have the capital, but can they keep the soul of those local businesses alive while they try to scale?
Check your own risk appetite before you bet on the consolidation of chaos. Thanks for listening to The Deep Dive.
Stay curious.
We'll see you next time.